Welcome back. 10 Network gained another 1.6 to close at $1.57 today after 2 days following James Packer's raid on the company's share register. 10 released its full-year results today, revealing a return to profitability with a $150 million net profit. For some analysis on 10 as an investment and media stocks in general, independent investment expert Roger Montgomery joins me in the studio. How are you, Roger?
I'm well, thank you.
Now, as soon as I saw this, I wrote it in my piece on my website.
Yes.
Yeah, I said, I'll go to my buddy Roger Montgomery and see what he thinks.
Sure. It's always baffled me the prices that media moguls are prepared to pay for media assets in this country. I mean, we have a tiny, tiny economy. By global standards, we have 22 million odd people, and I'm sure that you can still make a lot of money, but you can't. If you pay too much, then your returns are simply going to be lower. And the bottom line is, the more you pay, the lower your return's going to be.
Yep.
Let me give you some numbers. Before I do that, 10 is in a difficult position from the perspective of media buyers compared to 7 and 9, because it really offers no cross-media opportunities for them. So they don't really own any non-TV media assets. They're just a pure play. Bottom line, you know, I rank companies in terms of quality, and I have a bunch of ratios that I use to measure quality, and I look at them longitudinally, so over time, not only at one point in time. And I rank every single listed company from A1 down to C5. Well, 10 gets a C5. But that may be the very reason, you know, maybe that performance, that could be the very reason that James wants to get involved and make a substantial improvement there. Because there's definitely an opportunity. It can't get a lot worse, it can get a lot better. The return on equity over the next 3 years is forecast to be between 11 and 14%. Now, those are forecasts that were they're based on forecasts that were prior to James's raid on the shares, and there's all sorts of speculation now about what he's going to do.
Are they the forecast the company's making, or are they forecast that you're making?
I'm looking at the analysts who are closest to the company and what they think. So 11 to 14% return
not bad
on equity. Not bad, but it's not stupendous. You know, Oraton makes 85%.
You love Sally,
JB Hi-Fi makes 45%. There's a lot of companies. Reject Shop makes 40-odd% or 50%. So, you know, bigger numbers than are available here. Because of those low rates of return on equity, it's probably worth its book value, or maybe even less, depending on what kind of rate of return you want. But I'm valuing these based on a passive shareholder in the company, whereas James can get in there and stir things up. He can bring in a few people.
And change those figures.
He can bring Gingell in, you know, he can do a whole bunch of things and make some changes. So my valuation for this year is 66 cents. Now that compares to the price.
It got to 65 during the GFC, didn't it?
Well, I don't know, because it never met my criteria, so I never looked. Now, I've got the value rising. I've got the value going up to 86 cents next year and 98 cents the year after. But again, that's based on the status quo being maintained. It isn't based on James getting in there and shaking things up.
So there we go there, mate. You can see
they haven't gone back far enough there for us to have a look at whether or not the GFC did in fact see the share price down there.
Good point.
Okay, but here's the interesting thing. They're going to earn $60.5 million. That's what's being forecast. $99 million this year. 10 years ago, they earned $60.5 million. So over 10 years, profits have grown from 60 to 100 or thereabouts. That's not a huge rate of increase. You know, it's not a big rate of increase. But here's the interesting thing. 2004... they earned $79 million, so $20 million less than what they're going to earn. But they did that with $491 million of equity and $434 million of debt.
By the way, there's your...
Oh, there's a long-term... well, there you go. It was below 50 cents, according to... Well, that was quite some time ago, wasn't it? But during the GFC, about $1?
Yeah, $1.
Looks like.
Okay.
So here's the interesting thing. 2004 earned $79 million with $491 million contributed by owners, sort of what's been put in and what's been left in, and $434 million lent by the banks. This year they're going to earn $20 million more, but they've got about the same debt, $395 million of debt, but $806 million of equity. So, you know, so arguably that additional, call it $300 million, $300 million of equity is only producing a $20 million increase in profit. So less than 10% rate of return.
And this is a classic situation then that the famous Roger Montgomery disclaimer comes with, that a company can actually go up on the market.
Sure.
But it doesn't necessarily mean that it's going to do it for a long time.
Well, have a look at this.
Yeah.
Let's talk about that for a minute, because that is the classic Montgomery disclaimer that I can't forecast the share price.
Yeah. Well, you poo-poo West
10
Farm.
years ago,
West Farm has done a little bit better, but still doesn't pass the criteria to go $45, $55, which you'd want it to do.
Yeah, exactly. So I think...
So I'm finding excuses for you.
No, you don't need to, because I've got the stats all here. Thank you.
Just in case people...
So have a look at this. 10 years ago, the intrinsic value was $1.11.
Yeah.
And its share price was $1.93. This is for Channel 10.
Yeah.
Today, I've got an intrinsic value of 66 cents, and the share price is $1.53. So in 10 years, the share price is 40% lower, 40 cents lower rather, not 40%, 40 cents lower than where it was. Now, I haven't looked to see whether or not there's been any splits or buybacks or any of those sorts of things, but just on a share price change basis, share price is lower today than where it was 10 years ago.
So what we're saying, if you want to see a substantial change in your attitude to this company, the revenue really has to go up very substantially, hasn't it, to justify the kind of equity and debt it carries?
One caveat. Media assets in Australia don't seem to trade anywhere near their intrinsic value, or rarely do. I can't understand why. Their price is not justified by their economic performance.
But let's move then to any other media stock that you've got some analysis on.
Well, Fairfax.
Yeah, that's a good one to go for.
Fairfax is an interesting one. If I had the opportunity, I'd love to sit down with their auditors, and the question that I would ask them is, has there been a conversation with the board of Fairfax about the carrying value of the goodwill on the balance sheet? You know, there must be $2 billion of goodwill there on the balance sheet, and the return on equity for Fairfax is less than what you can get in a bank account. So arguably you'd say, well, if remember, equity is made up of assets minus liabilities. So if your return on equity is really low, that means your assets are arguably being carried at too high a level. And if you've got a whole bunch of goodwill that's the result of overpaying for something else, and in this case Trade Me in New Zealand, then you've got to wonder why it's being carried at that amount. Shouldn't it be written down to reflect a more normal rate of return on equity? And that's my argument there. I don't think... I think Warren Buffett recently said, or not recently, but last year said he wouldn't now buy a newspaper at any price. He used to be the biggest advocate. They were toll bridges as far as he was concerned.
Because people woke up every morning, they shaved and they bought a newspaper.
And if they wanted to sell their car or they wanted to sell their ladder or whatever it was, their lawnmower,
real estate,
they had to go through the newspaper. That's not the case anymore. And the younger generation don't seem to be that interested in news. James Packard doesn't seem to be that interested in news, hence his interest now in Channel 10. Some of the media reports are saying that their strategy of more news is probably the wrong strategy, and they've got to get back to focusing on the younger generation. That younger generation doesn't buy newspapers.
Yeah, good point. So,
and the intrinsic value of Fairfax significantly lower.
I have that computer in front of
significantly. We're not talking 10 or 20% lower than the share price. Significantly lower than the share price.
Is there
of
a
Fairfax.
media company where the intrinsic value?
No.
What about an online media company? Is it an online?
No.
So they all tend to be overvalued.
Yes, the lists, not all of the lists. They're not media companies. I like online businesses, but the best ones tend to be.
But most online businesses are looking like media companies, aren't they? Because they do use content to get people.
Well, yeah,
there.
that's right. But the great thing about businesses like carsales.com.au and real estate and Seek is they don't own the inventory. They charge the supplier and they charge the customer. They get a clip both ways. The only shock to them, of course, is if a whole bunch of their customers get together and decide to leave. That's a big shock. But otherwise, great businesses. And in fact, if you think about it, all online businesses, the very best online businesses, are just lists. They're just selling lists.
You've made money on 10 so far. You may well have made that money. Don't expect any further kicks, unless the market gets excited by James being in there. Long term,
unless the performance of the business improves, the share price won't do anything over a long period of time. There'll be speculation about things happening, and that's what we're seeing now. But long term, price follows performance. There has to be an improvement in performance.
He has to wave some real magic to make it happen. Mate, thanks for joining us as always.
Pleasure, Peter.